This session is sponsored by Crow Soberman. Very graciously, a word about them. Crow Soberman has been around for over 50 years and they built a strong reputation of excellent work that its team of dedicated professionals has done. And it's one of the premier chartered accounting firms in Canada. They are committed beyond tax returns and beyond financial statements to provide financial services that generate value beyond traditional deliverables. Their skilled professionals help to organize, prepare, and analyze financial information. Soberman is committed to quality in all aspects of their client's relationship. Pro Soberman offers comprehensive range of accounting, tax, and financial consulting services to meet the needs of the clients. They provide innovative solutions in a comprehensive range of services that help clients take control. We have this session in two halves. The first half will be taken by Alan and Ellie, so I'll need to introduce both of them, and they will be covering the costs and the cash flow aspect of the presentation today. Alan Wainer is a partner in Crow Soberman's Audit and Advisory Group. He's a member of Management Committee and he was partner in charge of education as well as human resources partner earlier. He subscribes to Isidore Sharp's business philosophy, which states that profits are regarded not as an end in itself, but a reward for providing true value to customers, helping employees grow, and behaving ethically as a corporate citizen. And very aptly, both his clients and colleagues describe Alan as trustworthy, dependable. He's always willing to go that extra mile. He regularly contributes articles to firm's quarterly newsletter, comments, and to the media. Alan's passion for education and his heritage has translated to the causes he's involved in outside the office. Currently, he sits on the Holocaust Education Week Steering Committee and acts as chair of the Liaison Greeters Subcommittee as well. Alan is also on the Board of Governors and on the Tour of Humanity Community for Friends of Simon Wiesenthal Center for Holocaust Studies. He is a member of the State Planning Council of Toronto. More importantly, he's a wonderful person. He has passion for community work. He's a teacher, speaker, and now a friend. I do need to introduce Ellie as well because I won't have another opportunity. We're going to make this presentation together. Ellie is also a partner in audit and advisory at Crow Soberman. He is genuinely committed to the personal and financial success of his clients. He has extensive experience in consulting to clients on their internal control systems and has provided recommendations to improve controls and management procedures. He has provided clients with system audits in place of transaction processing, and controls in place of transaction processing. These assignments included reviewing the processes and procedures established by management to ensure compliance with the predefined agreed upon procedures. Ellie also enjoys consulting with clients on general business and tax matters. He's actively involved with community through a number of associations, including Youthdale Treatment Centers. Welcome back, Ellie, and I have a new friend in Ellie as well. I will now call upon Alan to take this session. Please help me welcome Alan.
I'm sure you've heard the expression that cash is king, which will be one of the main themes of tonight's presentation. Well, this evening we're going to provide some insight as to why this is the case. What we're also going to do is we're going to mix up the evening with a bit of formal presentation, pose some questions to you, tell you some war stories, but most importantly have some fun. This includes giving out a couple of books. At the break when we have supper, there's a fishbowl where you can put your card or some paper where you can put your name in, so you make sure that you have an entry into getting one of these books on our topic area tonight. As Lalit said, my name is Alan Wainer, and of course my partner there is Ellie Palachi. With us are two of our managers and valued staff members, Talia Rubin and Lauren Rapkin. Over the next few hours, we're going to provide you with some assistance on addressing and managing cash flow. understanding costs and financial statements so that you leave here tonight with a better understanding of the financial side of a business. There will be about a half-hour break for supper to split up the evening. We will conclude by answering any further questions that you may have for any of us in our closing remarks. I don't know about you, but when I attend a seminar, especially in the evening after a long day, I get a lot more out of it when there's a two-way conversation between the presenter and the audience. So let me set the tone for this evening's presentation appropriately by posing a question. When you leave tonight's session, can you tell us 3 things that you'd like to learn, that you'd like to take away from this evening's presentation?
Reading financial statements.
Anything else?
I gotta write.
Anyone else? Go ahead. Matt.
Manage cash flow.
Pardon?
Manage cash flow.
Okay, how to manage cash flow. So reading financial statements.
Financial statements. 2.
Managing cash flow. Anything else?
Making finance fun.
Making finance fun? Got to work with the right people. The idea of this is, as we go through the evening, we'll look back at your responses during the break and before we start the next set of part of it, to make sure we cover these areas in some fashion. What I'd like to start with is a bit of a war story. Actually, when we were here last year, that war story was in progress, and it still continues. It's almost like a television show. We have a client in our office who had developed a lot of wealth in an industry and decided to take a different tack and in a similar industry, but he wanted to construct a building, and the building was going to be used to repair equipment, and he felt he had enough of his own backing, financial backing, to put the building up and get started. And we try to tell him that there's more involved than just saying you have enough money at hand to put the building up and get the business going and have to deal with startup costs. As things progressed, he started realizing that he may run out of money because the initial cost estimate by the contractor to put up the building was a lot lower than it ended up being. Sound familiar? So anyhow, we got more involved, helping him with someone else that we brought on board that he actually knew. Put together a business plan, including cash flow projections. And while we were doing that, we tried to help him get some financing by getting some financing on some personal real estate that he had. And he saw the process took a long time. We are happy to report that about 2 months ago, he actually, through the business plan and this advisor that ended up being his internal CFO, getting all the financing he needed to pay off his contractor, who he owed a lot of money and who was charging him a pretty high interest rate, let's just say double digits, and has enough to get the business going. So, you know, the moral of the story is the planning involved should have been done at the beginning, but it wasn't. And as we go through some of what I'm going to cover and what Ellie's going to cover, you're going to see where this war story comes into play even more. So let's get started on the startup business as our guidepost, because what we're going to tell you applies not only for a startup but for an existing business. A startup business begins often with ideas and a lot of enthusiasm. One of the main issues that every entrepreneur must deal with in starting a business, a small business, is the financial reality involved in deciding exactly what he or she wants to do, when it can be done, and how does it want to get done. In other words, what are their plans? We all know the best way to structure them is in the form of a business plan. Just to refresh your memory, The components of any business plan would include your cover page, your table of contents, an executive summary, business background, the entity, the product or service description, the business facility assessment or location, marketing plan, action plan covering operational and management issues, financial elements, and possibly an appendix with supporting documents. Business plans, as I'm sure you know, are not just a necessity for a startup, but for those businesses in the growth and maturity stage as well. Although your product and location of your business are key elements to any business plan, the projected cash flow budgets are vital. In a startup situation, you're going to have to rely mostly or almost entirely on financial projections, meaning they'll be based on assumptions that you have made as to how your business will perform in the future. You will also have to rely on your ability to sell yourself as a potentially successful business owner, which takes me back to that first war story that I mentioned just a moment ago. My client's ability to put together finally cash flow projections needed to obtain an operating line, and selling his experience in the business helped him get the operating line. And also he made sure that the cash flow projection was based on contracts that he was expected to sign once the building was complete or near complete. So with that in mind, let's start with the 5 aspects of managing cash flow. I will cover financial goals and working capital, that I consider the dry area of the presentation, and developing budgets. Ellie will cover monitoring budgets and managing cash flow. And Talia and Lauren will cover nature of costs and understanding statements, financial statements after the break. Don't be surprised if any of the presenters put in their 2 cents during my part of the presentation, or me in their part. And it's just our way of keeping each of us on our toes. But we do expect you to ask questions, so you'll get more out of the presentation. Any questions at this point? Yes, go ahead.
You mentioned about the business plans. What aspects of the financial aspects should be on the business plan? That's going to be discussed as part of this, or is that a separate discussion?
Business plan?
Yeah.
We had a separate session for that.
Oh,
Sorry.
It will be covered. The financial aspect is really more about when you do a business plan, is to have the projections. And I'm going to help walk you through what's involved in putting together a budget. So it will be covered. Okay. Anyhow, so let's just go through. Okay, we talked about plans and goals. Like, why are financial goals important? As you can see from the slide, it provides focus and direction, it sets targets, and it helps you realize your full potential. In simple terms, it's similar to steering a ship. You cannot reach your destination if you don't know what direction you are going. Well, setting SMART goals. I'm sure you've heard an acronym. They have to be specific, measurable, attainable, relevant, and time specific. I'll go through a couple of the points and give you an idea of the relevance of each, or the importance. Obviously, they have to be specific. They have to be clearly defined. How much money are you hoping to make, for example? What will it be used for? What do you need it by? The goals have to be realistic. Write down your goal and discuss it with others you're working with. Committing yourself to your goal by writing it down and discussing with others makes you more accountable to achieving it. In terms of time specific, okay, prioritize your goals. What must be reached in the short term versus the long term? Short-term goal could be, do I have enough money to purchase office equipment or achieve a monthly sales target? Long-term goals could be things as reducing reliance on external financing or achieving a certain level of sales in your first 2 or 3 years. But you should break down your long-term goals into shorter periods with targets for each. So this is really setting the parameters, setting the foundation for building not only a business plan and cash flow projection. It's with everything you do. If you think about it, and anything you've accomplished in your life, if you set goals, it helped you provide direction, and help you achieve them. So let's continue. And remember, if you have any questions, please ask. Working capital. In its simplistic form, working capital is cash on hand plus cash coming in minus cash to be paid out. The more refined definition is it's the operating liquidity available to the business. It's defined as current assets, cash on hand, receivables, inventory to be sold, less current liabilities, payments to suppliers, taxes owing, short-term loans, current portion of long-term debt or mortgages. Current usually refers to cash transactions that will occur within the following year or one operating cycle. So why is working capital so important? It's because it's a snapshot of your short-term financial position and your ability to meet your obligations during that short period. And it helps you establish your credit rate. And it's important, and that's important to show how you're able to pay for your obligations. So how does one manage working capital? Well, the one thing is, it's important to know that it has to be positive as soon as possible. Obviously, that may not be the case in the beginning of starting up a business. It helps you manage your credit and payment terms. For example, if suppliers of your product demand payment within 30 days, but you know you can only collect receivables in 60 days, you know there's going to be a gap, and how you're going to fill that gap, and hopefully that will be with some startup financing. Maintaining up-to-date records. If your records are a mess, you're not going to know where you stand when it comes to your working capital. Obviously, if you have the right software package and you keep it up to date, you'll know at a given point in time how much working capital is available and whether you need to potentially call a supplier and ask for a delay in making a payment or not. Ensure invoices clearly state credit terms for customers, and always use invoices. And for long-term projects, don't be shy to ask for interim invoicing and progress billings. Don't wait until the end of a project. It's going to last a few months because that's going to hurt your cash position. Keep business separate from personal expenses. For a number of reasons, the most important is you're not going to know really how well your business is doing if you're putting personal expenses and they get commingled and you're not keeping track of them. And use the tools that are available to you, being purchases with a company credit card or debit card, so the purchases can be tracked for ease of viewing. So now we get to a budget and developing budgets. What is a budget? I'm sure you've heard some of these things before. Organizational plan stated in monetary terms, basically your revenues less your expenses. It's a tool to project future cash flows. It can be short-term or long-term. Or another way of looking at it, it's a financial communication device. And that last part is very important to a banker. Short-term budget is a year. Long-term budget is obviously more than a year. The longer out you go, the more assumptions, the more unreliable that budget would be. The long-term budget, though, tends to be more goal-oriented. It helps you track your progress towards long-term goals. The results of your short-term budget should be incorporated, of course, into your long-term one. And as I said, it's important not to plan too far into the future because, as you know, we live in a volatile world and we have an uncertain economy. Preparing a cash flow budget involves, in simple terms, 4 steps. You start with your sales forecast, and then you project inflows from your sales, you project your outflows, and you combine the two to come up with your bottom line. But that is very simplistic. This is where we get into the hard part of developing a budget, the assumptions and the control sheet. The assumptions are very key to doing any budget. some of the things to think about. How much is your sales gonna grow from month to month? What are the purchases required to match those sales? What's your gross margin gonna be? If you have equipment, how quickly are you gonna amortize or depreciate it? If you have a line of credit, what's your interest rate? If you have long-term debt, which usually applies to capital assets, purchasing capital assets, how quickly will that have to be paid? What's the interest rate? What income tax rate are you gonna use? So all those have to be factored into preparing your budget, and that's your assumptions, and how quickly will you collect your receivables, how quickly do you have to pay your payables. A budget should be consistent, as I said before, it's very key with your business planning goals. If it's an existing business, obviously you can look at your past performance. If it's a new business, then you can look to similar startup ventures for their experiences. It will speak to your network. Go ahead.
Very good. As you said, there's a lot of assumptions to come up with the budget. But everybody know things might change in the future. Economic conditions might get worse. So
Hopefully they get better.
better. So is it better to take when you, let's say, the business cycle or account receivable is every 30 days, according to our assumption. So is it better to take more precaution when you come up with the number instead of 30, say 25, or at the end take 0.8 factor, just for the safe side? Which one is preferred? Which one
Well,
is better?
I think if I heard the question properly, whether you should be a little more conservative in terms of some of your assumptions. In a startup business, definitely incorporate, as it indicates at the last bullet point, be conservative. We as accountants tend to be conservative, so when we help clients develop budgets or cash flow projections, we always put in contingencies. And so we'll probe, and if you think it's 30 days, what if, and this is where the control sheet, which is a good segue, the control sheet is where you put certain factors in and you can then play with developing your budget. So on your control sheet, you can put, receivables effect in the formula are going to be collected in 30 days. What if it's 40 days? What if it's 45 days? What if it's 60, etc.? Or what if the interest rate is 4% versus 5%? You can play with all those factors, and then you come up with, obviously, you want to be conservative, but at the same time, you want to portray a pretty good, or reasonable, realistic picture to the bank. Right? So you're trying to balance that, because obviously you may, the opposite, when you want to try to get financing, you want to show a rosy picture to a banker, but at the same time, from your own perspective, you may think, well, it's too conservative and I won't get the financing. It's a balancing, and that's where looking at other businesses, through your network, through help that we sometimes will provide to our clients, we will tend to, as I said, we'll tend to be conservative, and we'll ask, well, what if, or in your line of work or this type of industry, is this being too conservative or is this being too aggressive? So that's where the assumptions in the control sheet prove a lot of value. And, if you know people in a similar industry, that will obviously help, because they can provide guidance. And sometimes it may be a friend, it may be someone in your network, it may be an accountant, it may be someone even at the banks that they can help out. Have I answered your question? Budget's supposed to be more broad. You don't need to know how much pens you're going to need for people in the business. To give you a very simple example. So let me run through briefly, and there's one handout, even though everything else you can get off the website, which we'll give you at the break, is a template, which I always found very useful in helping people, especially when they start up. You've got initial setup costs. So here you've got So you don't have to remember all these things. And it, it runs from A to Z, and I mentioned fixtures and equipment, initial license and permits, etc., signs, etc. So it gives you a pretty good guideline. So that's Schedule A. Schedule B, again, because it's a startup, what are your personal living expenses? And this continues along the way, covers everything from A to Z. And then for your first 3 months of your business, what's your revenue going to be? What's your expenses going to be? And then you come to the end, and the recap is basically your snapshot. My initial business setup costs, the operating dollars needed for the first 90 days, add those two together, plus your personal cash needs. If you're fortunate, you may be working part-time while you try to get the business set up, or you have a better half who's got a full-time position to help make starting your business a lot easier, or not as difficult, because you have some cash coming in. And at the end, you know what your cash needs are for your personal business and startup for the first 90 days. So before I pass it off to Ellie, do you have any other further questions? Go ahead.
So as a startup, how do you build your credit history?
I'm sorry?
How do you build your credit history?
It's a chicken and egg. Hopefully, again, I'll give you an example of what I've tried to do with my own children who have or are going through university. We got them a credit card, and to build history, to build some credit. So that's part of the process. But generally, the difficulty is when you start a business, you don't. And of course, there are some programs that the banks offer in that regard to help you when you don't have the credit history. The key is to remember, if you've got a house, you've got a mortgage, potentially, and you were working for a few years, that will also help build some credit. But what you will find when you start a business, the odds are either you have to get some through small business loans through the banks, or you may have to take an additional mortgage on your home, which is risk, obviously, because it's ideally you'd love to keep your personal stuff separate from your business to help finance it. And over time, by staying on track with payments for those loans, build up a history. But it takes time. Anything else? If anything else comes to mind, please. Go ahead.
On the sensitivity in relation to the conservatism. Having if price goes down by 10%, you can have the scenario building in the budget.
Well, that's where the assumptions come in the control sheet. That control sheet is everything, because when you do an Excel spreadsheet and you develop the control sheet, it allows to do the sensitivity analysis. As you asked the question, if sales went up 10% or went down, or pricing went up 10% or down, that could tell you how much your profit's going to go up or go down, and so you can run different scenarios and see which one makes sense, and possibly try it out. Meaning, if you've got a new product, you don't know how price sensitive it is. So once you have your first sale, you may have an idea, and then you can go back to your budget and say, you know what, I priced it at, I'm just using as an example, $100 per unit, and I didn't get much resistance, and I tried second time with a customer, and I'm getting 120. So what does that mean? Based on how many units I'm projecting to sell. So the budget is obviously key in doing any business plan. It's got to tie back to other aspects of the business plan. For example, if you're going to be selling the geographical location, what does that mean relative to the budget? If it's a cyclical business, perfect, simple example. If it's a cyclical business, the sales should tie into what you just said before earlier on the business plan, to say, well, the vast majority of sales are going to be during the summer months, or there's going to be in the spring and the fall. Well, the cash flow projection should tie back to that. If it doesn't, number one, you're comparing apples with oranges. And two, whoever you're showing that business plan to provide financing, you're gonna not have much credibility because they're gonna pick that up pretty quickly. Any other questions?